now.
안녕하세요. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우 한국경제신문 강영현입니다. 제가 오늘은 스튜디오가 아니라 이렇게 집에서 영상을 촬영하게 됐는데 약간 예측하시겠죠? 코로나에 걸렸습니다. 그래서 오늘 집에서 찍다 보니까 화면이 화질이 조금 떨어지는 점, 그리고 제 목 상태가 좋은 편은 아니어서 음질이 조금 떨어지는 점 이제 양쪽 다 양해를 부탁드리겠습니다. 그래도 저희가 일주일에 한 번씩 인터뷰 올리고 있는데 약속을 지키기 위해서 영상을 만들었으니까 예쁘게 봐주시고 많이 봐주셨으면 좋겠습니다. 그리고 인터뷰 시작하기 전에 제가 약간 공지를 하나 드리고 싶은데, 댓글에 보면은 그 인터뷰 시점 관련해서 이야기가 많이 있으시더라고요. 그래서 관련해서 조금 이야기를 드리고 싶은데, 저희가 이 인터뷰를 하게 됐을 때 바로 올릴 수가 없습니다. 윤재성 CIO 인터뷰들 많이 보셨을 텐데, 그 인터뷰 같은 경우도 저희가 금요일에 했는데 그 다음 주 수요일인가 목요일쯤에 올라갔던 걸로 제가 기억을 해요. 왜냐면 인터뷰를 그냥 한다고 바로 올리는 게 아니고 저희가 자막도 달고 뭐 이런 자료도 넣고 이렇게 편집을 해야 하다 보니까 시간이 조금 걸리는데, 특히 뉴욕나우 같은 경우는 이제 저희가 인터뷰들이 다 영어로 이야기를 하다 보니까 저희가 번역을 맡겨야 돼요. 한국말로 적어야 되잖아요. 그래서 번역을 맡겨야 하고, 또 저희가 목요일 날만 올라가다 보니까 그 시간이 조금 미뤄지는 점이 있기는 있습니다. 하지만 그것을 고려해서 제가 최대한 텀을 짧게 만들려고 인터뷰 스케줄을 잡거든요. 그래서 생각보다는 많이 그렇게 긴 텀이 있는 건 아닌데, 그래도 일반적인 다른 선배들의 뭐 데일리 시황이나 이런 것과 비교해서는 약간 텀이 있다라는 점을 말씀드리고, 그래서 이제 제가 그런 한계를 인식하고 있기 때문에 노력하는 게, 저희가 사실 데일리 시황 같은 경우는 저희 존경하는 조재규 선배와 김현석 선배께서 매일 글로벌 마켓 나우와 월스트리트 나우를 통해서 전해주고 계시잖아요. 그래서 아무래도 뉴욕 나우는 그것보다는 조금 더 중장기적인 관점에서 시장을 바라보실 수 있도록 그런 의견을 많이 물어보는 인터뷰를 진행하려고 하거든요. 그러니까 단기적으로 뭐 일주일 안에 시장의 변동성이라기보다는 뭐 올해, 뭐 분기, 뭐 내년, 뭐 이런 식으로 그런 조금은 중장기적인 전망을 가진 인터뷰를 하려고 노력을 하니까, 데일리 시황은 또 김현석 선배와 조재규 선배 프로를 참고하시고, 조금 더 중장기적인 투자 관점이나 이런 아이디어가 필요하실 때는 뉴욕나우를 활용하시면 어떨까, 그렇게 생각을 해보고 있습니다. 네, 그래서 오늘 인터뷰할 분은 로렌 굿인 뉴욕생명 이코노미스트입니다. 뉴욕생명은 다들 아시죠? 윤재성 CIO께서 CIO로 계신 그 회사고요. 거기서 이코노미스트로 일하시는 분이고, 그 전에는 JP모건, 웰스파고 같은 글로벌 IB에서 이코노미스트로 일을 하셨었고, 그 전에는 OECD에서도 근무한 경험이 있는 거시경제 전문가이십니다. 특히 최근에 변동성이 심화되면서 조금 안정적인 투자를 위해서 자산 배분 관련 관심이 늘어나고 있는데, 그쪽 전문가시다 보니까 오늘 인터뷰에서는 자산 배분 관련된 이야기도 좀 나눠보겠습니다. 이 인터뷰는 3월 30일에 진행을 했고요. 앞서 말씀드렸다시피 그런 사정으로 인해서 인터뷰 업로드 시기는 이거보다 조금 늦습니다. 이해 부탁드리고요. 오늘 인터뷰 시작하겠습니다. Market volatility has been severe this year. How long do you think this volatility will continue? Where do we stand now in terms of market?
Volatility is always a risk for investors, but it can be tolerable as long as investors are optimistic about either the economic and earnings backdrop for companies or for multiple expansion opportunities. Now, in that latter category, these are less likely now that interest rates are on the rise. And so investors have to focus on the economic growth or earnings part of the story. And here we expect that we're in the middle phase of the economic cycle. The initial boost in economic growth after the pandemic crisis has peaked and is likely to fade over the coming months. But for now, that growth is still there. It's still strong. And so we expect positive results in equity markets as earnings are released. But over the next 4 to 6 months, that impulse will fade somewhat as leading economic indicators do. And so in this case, we're staying invested, but we are starting to build resiliency in our portfolios against that slowing growth.
The market has been on the rise since the middle of this month. Do you think most of the news is priced in? Can there be a bigger correction within this year?
Well, if we've learned anything over the last 2 years, or maybe even the last few weeks, there's always a chance for a correction or some unknown risk to impact the markets. This market is priced for perfection. That means that it's priced for all of analyst expectations around the path of interest rates or earnings or economic growth to be correct. And we certainly hope that's the case. And if major risks related to the health environment globally or geopolitical risks fade over the coming months, then it would be. But the path ahead is highly uncertain. And so investors will have to be building flexibility into their asset allocation and agility in the way they monitor the economy and markets in order to be successful in this type of environment. And for many investors, that's challenging to do. It takes a lot of work. And so we are recommending investors consider active management, given that there are so many cross currents in the economy right now.
In this case, how should investors behave? Some experts advise that it is time to invest in financial and energy stocks instead of tech. The other says tech stock is cheap enough to buy after correction, and oil prices are now at their peak and will fall. What do you think about this? What industry should investors be interested in now?
Really, earnings that are driving this market. And so earnings growth, the capacity for a company to contribute positively to an investor's portfolio is more important. That individual security is more important than any headline sector perspective. But that said, of the sectors that you've mentioned, it's the energy sector, in our view, that has the strongest macro headwinds right now. We learned in the oil crisis of 2014 to 2016 that energy companies can be profitable at $55 per barrel, both upstream and downstream energy companies. And that says that energy prices, oil and gas prices, could fall quite a bit from here, and those companies still be profitable, still provide investors with reliable earnings. And so that's a major tailwind for the sector. It tells me really two things, two important investment takeaways about the sector. One is that it can be tempting to invest directly in commodities like oil and gas when prices are high, but that the related companies, the energy sector as a whole, may be a more durable investment, a more durable way to leverage those higher prices. And the second thing I think is relevant is that the pre-existing conversation around the energy transition is highly relevant here, because energy companies, the energy sector, doesn't only invest in oil and gas. There's also major investments in electrification, asset modernization, digitization, and overall the infrastructure to make these investments possible. And so when we think about the energy sector, we also try to consider the future of the sector and what investments might be relevant there. And there's a lot of change going on, so a lot of opportunity to invest.
What do you think is a safe asset to invest in now?
Well, safety depends on what risk you want to be safe from. And investors are facing a lot of very different risks right now. It's not just inflation or central bank policy or the COVID crisis or the Ukraine crisis. It's all of these things, and they can be very tied together and interdependent to one another. And so while we think it's too early to turn to defensive themes to really focus on safe haven asset classes, we are starting to build resiliency against some of these risks. And one of our highest conviction ideas, again, I've spoken a lot about earnings and quality earnings. We see a lot of that in value equity. So when the economy is still strong, perhaps slowing, but still strong, and investors want to look for that earnings growth, quality segment of value equity can provide that mix of factors in a way that we believe is very attractive for the next few months.
What do you think about big tech companies such as Apple, Alphabet? They made the quality earnings and have a price power, but some point out their valuation is too high and it is sensitive to rate hike. What's your view?
The tech sector faces important cross currents because on one hand, many of these companies do provide reliable earnings, quality earnings. That's what's most important in the market. But many tech companies are also longer duration equities, meaning that their valuations are very sensitive to increases in interest rates. And so since we do expect interest rates to increase over the next several months, the quality portion of the tech sector is particularly important. And so while when we think about value equity or growth equity as sometimes against each other, or defensive themes and technology themes sometimes as being opposites, it really is about which companies, including in the tech sector, can provide those reliable earnings. Those that can, reliable earnings, high return on invested capital, we believe will provide some resiliency in a portfolio even amid high and rising rates.
Fed predict inflation would remain 4.3% until the end of this year. It's lower than it is now, but it is very high number from a historical point of view. What is the best asset allocation strategy during the inflation era?
Well, many investors think about inflation in terms of traditional inflation protection strategies. So that's things like commodities, treasury inflation protected securities or TIPS, precious metals. And these can have a role in a portfolio, especially for investors who have the risk tolerance or who work with active managers who can navigate the rapid volatility and changes in prices in these asset classes. But thinking about inflation for a portfolio is more than just about inflation itself. It can be quite complicated for two reasons. The first reason is that there's a trade-off between the higher nominal cash flows that come with inflation, which is a good thing for many asset classes, and then the higher discount rate that tends to accompany that increase in inflation. That can be a drag on valuations. And the second thing is that the best investment strategy related to inflation depends not just on inflation, but also on growth. Because if inflation and growth move together, that can again be constructive for the markets. Whereas if inflation is moving higher while growth is slowing, that can be challenging. So as you can see, it's quite a complicated picture. And so when we think about inflation in a portfolio, we really try to focus on building resiliency against inflation. So that can mean focusing on equities in a portfolio where higher costs can more easily be passed to customers, earnings can be preserved. But we can also think about other asset classes that either provide cash flows linked to inflation or that help to navigate the rising rate environment, or that rely on more durable themes in the economy and policy. So there I'm thinking things like infrastructure equity, real estate equity, floating rate bonds, convertibles. Again, this more holistic approach to asset allocation can help to consider all of the factors that come with inflation rather than just the inflation itself.
There is a 60-40 strategy. 60 is equity and 40 is bond. Do you think will it still work in the era of inflation?
Okay, awesome question. We believe that for the average retail investor, the 60-40 portfolio is still a valuable framework, even in an inflationary era. The trick here is to think more creatively about allocation to each of those factors. So the traditional 60-40 portfolio is 60% equity and 40% core bonds. But just taking the fixed income portion of that first, core bonds tend to underperform in a period of higher interest rates. And so we want to think more creatively about that bond exposure to bring diversification to an investor. So things like floating rate securities, convertible bonds, or even thinking about income-focused equity as a way to build income in the fixed income portion of a portfolio can, again, help build resiliency against some of the changes in the market. And the same is true in the equity side of a 60-40 portfolio. Some of those durable investment themes like infrastructure can be valuable in making that framework more flexible for the macroeconomic environment at hand.
Finally, the Fed approved the first interest rate hike in more than 30 years and sees 6 more ahead. Can you talk about how those affect the US stock market and economy? Even though the Fed has now begun to hike rate, do you think it remains behind the curve in addressing inflation?
I do think that the Fed is behind the curve, but that was its goal. It wanted to be behind the curve. We had in the US and in many countries globally been struggling to keep prices stable at a level that would allow wages to increase in the economy. And so allowing inflation to firm somewhat was part of the Fed's goal in this. But now that the Fed is behind the curve and it's beginning to hike interest rates, it does have an impact. If we think just in economic terms first, that impact right now is very small, maybe even no impact to the economy. And that's because companies, many have a borrowing floor on their borrowing costs, meaning that it takes until 1% or in some cases 2% before the Fed's interest rate increases are even felt in their borrowing costs. And that's similar for households who have done a lot of work over the course of the last expansion and with stimulus checks during the pandemic crisis to pay down debt to shore up their balance sheets. But of course, the more that the Fed hikes, the impact will be felt. And that's its goal, in fact, with these interest rate hikes, to tame this surging demand so that supply has some time to catch up. Now, on the market side of things, the impact of the Fed's rate hikes has already been felt almost immediately in the economy, even before the Fed started hiking interest rates. And the way that the Fed's interest rate hikes work their way into the markets are plentiful. It has an impact on market liquidity, market functioning, has an impact on economic growth expectations, which we've already discussed a little bit. And then it also has impact on valuations as interest rates rise. And we've only had one 25 basis point move in Fed rate hikes, but already the markets have really felt the changes in expectations related to these factors. We've seen changes in corporate credit spreads, changes in the curve structure of rates. And so for investors ahead, any changes in those expectations will be felt in market volatility. And since there is so much uncertainty in the economic outlook ahead, we expect that volatility related to Fed policy will continue.
If Fed get very aggressive, as we already anticipate, but potentially even more aggressive, are you worried that we actually could be looking at increased recession risk at this point? Some experts worry that policy mistakes in the US as the Fed has embarked on a tightening cycle to rein in inflation.
Yes, the market is already increasing its probability of recession risk ahead. We're already seeing that in market pricing. The question for the economy and markets ahead is, would that recession risk be a policy risk, as you ask, or is it actually necessary to rein in inflation? And that really depends on whether it takes the Fed to hike either close to that 2 to 2.5% neutral rate of interest. That's the interest rate that doesn't stimulate, nor does it constrict the economy. Or will it take hiking much further than that to really slam the brakes on inflation and bring it under control? There are many investors, and actually even the Fed itself expects it will have to raise rates a little bit past that neutral interest rate. Some, though, expect that it might have to raise rates even higher than that. We're on the different side of things. We're looking at especially market functioning, market liquidity, and expect that the economy might start responding to interest rate increases sooner than the 2 to 2.5% neutral rate of interest. That said, the closer we get to that neutral rate of interest and moving past it, the more likely a recession would be.
Market consider a yield curve inversion that could signal of recession. What do you think?
Yes, curve inversion is a really important indicator for markets. It is certainly a caution signal for us as investors, but there are a couple of caveats here. The first is that, and I love this joke, that the yield curve has predicted 9 out of the last 5 recessions. That means sometimes we do get yield curve inversion and a recession is not ahead. In this case, especially considering slowing growth, high inflation, there is a risk of recession in the economy. But the second caveat is that yield curve inversion doesn't tell us much about the timing of a recession. And in fact, in past economic cycles, curve inversion we've seen 4-6 months of positive equity returns before starting to turn to a more cautious stance. And so we take that signal of curve inversion very seriously, but it doesn't impact our allocation today. Now, where we would start to change our allocation is if we saw a stronger inversion in the very short end of the curve, we're thinking, the 3 months to 1 year portion of the curve, that to us would be a signal that the market is starting to capitulate, and it could be time to add duration to our portfolios. But until then, it's just one indicator of many to be careful, tread carefully in the market ahead.
Well, if you have $1 million in current market situation, how would you like to invest? Give an insight to our investors.
Well, the first thing I would say is to invest it. It's so important to stay invested for most investors. There's always reasons to take risk off the table, but having that $1 million in cash is a drag on long-term financial wealth when inflation is this high. And so that's the first thing. Definitely invest it. From there, the strategy really depends on investors' goals. But one of the questions you asked earlier related to the 60-40 portfolio, I think is really salient here to build diversity and flexibility in a portfolio for the macro environment. And so that means, thinking not just about bonds and fixed income and equities and maybe some alternative strategies, but to balance those across the portfolio. And so while it might sound a little bit boring in terms of an investment idea for $1 million, I really do think that it's the most effective way to manage financial futures, because for most investors, it's all about the goal that they're saving for. And preserving or keeping focus on that long-term goal is most important.
Some said we should invest in gold when inflation is severe. Do you recommend investing in precious metals such as gold and silver?
Precious metals have value in a portfolio, especially in an inflationary environment, or by contrast, in an environment when central banks are engaging in quantitative easing. Now, we have one of those right now, not the other. And so there's a role that precious metals have to play. But like many commodities, the prices and valuations of precious metals can ebb and flow dramatically. And so a small allocation can bring some diversification into a portfolio and can build resiliency amid inflation. Having a large allocation is unlikely to make sense for most investors in order to preserve that resiliency and diversification.
How about digital gold, Bitcoin? Cryptocurrency also included in your portfolio?
Well, I get to escape this question a little bit because in our portfolios, we aren't allowed to hold it. But in order to answer the question honestly, digital currencies for us are not just about the price of any one individual currency, Ethereum or Bitcoin or what have you. It's an investment in blockchain technology. And there we think there is some really constructive story for the future, the way that the financial system is changing. And that can be really interesting. And so when it comes to considering a Bitcoin investment or a blockchain technology investment, a couple things that investors should keep in mind. First is that the volatility of these asset classes can be extreme, even more extreme than some of the commodities that we've discussed today. And so a small allocation is likely to be appropriate rather than a large allocation for most investors. Of course, if the money isn't a part of your long-term wealth strategy, then feel free to do what you want. But when it comes to retirement or long-term goals, a small allocation is likely to be appropriate. The other thing is to really keep in mind that underpinning, that financial markets future underpinning to the investment itself. And so when considering which type of digital currencies or technology to invest in, doing the research and considering those options, I believe is really important in order to make the right investment. But what we do see is that, again, much like the more volatile commodities that we've discussed, these digital currencies can provide some diversification for a portfolio in small doses. So if it's of interest, proceed with caution.